What's up, Resource Nation? I'm really excited because we have a reoccurring guest and good friend that carved out special time for us. It's really hard to get him, but before I get to him, let me kind of tee this up because we had an amazing interview with Barry last week. He talked about his interview with Ivy Zellman. These are two incredibly intelligent people, and they had varying opinions on where the market's headed, even just next week, let alone next year. So that was really interesting to listen to. Ivy talked about a 1% decline in home values, which is interesting and I guess possibly could happen, but it's hard to believe when you look at some of our guests' writing that I'll get to in a minute. In Redfin stat last week that launched, which said homes for sale at an all-time low. And I think the stat was down 23% from 2020, down 42% from 2019. So when does the madness end? Who can make heads and tails? How does Omicron impact this? How does the Fed tapering impact mortgage rates? How does unemployment, employment, household growth, population, how does that all impact it? Who can keep it all straight? The good news is my good friend and guest can, and he has written about it since day one, since I've known him. He continues. We will post a couple links to some recent articles as to why I reached out to him. Housing Wire lead analyst, our good friend, Logan Mohtashami. Logan, thank you so much. You are a hard man to get these days, and I totally understand why. You carved out time specifically for the RE source, and for that we thank you.
Hey, it's great to be here with Seahawk fans who are not going to.
Still Seahawk fans, nonetheless, because it's OG from '77, so I'm not giving up yet. But thanks for the dig. So it was a long intro, man, and you've written a lot about everything I just talked about, and it's I know for you, I like talking to you. Facts don't have feelings with you. You're a stat guy. You dig in, you analyze, and you've been very, very positive. You've been right on a lot. So help us remove some of the emotion of the up and down and what's happening tomorrow or next week and next year, rates, inflation, all this stuff. Help us take the emotion out. We're speaking to educated loan officers and realtors and appraisers. They're trying to make heads and tails. You're one of the few that can actually help us understand this better. So, let's kick it off with some of your recent writings, and you can speak to everything I just talked about.
Well, my work is really demographically based, and obviously the housing bearish people in this country, what I call the lost decade, have been bearish for a very long time, went all in 2020, and I adamantly said, this is not going to happen. You have the best housing demographic patch ever recorded in history. You have the lowest mortgage rate. You have the best credit profiles ever in history, so housing will be fine. We had the V-shaped recovery. We're good. 2021, of course, what every trolling group does in America, they move the goalposts to next year. Really, they're moving out of the stadium. So they went all in, the forbearance crash bros, which I documented last year, giving them that nickname because they can't help themselves. This has become one of the biggest crash cult groups in our history. So they went all in. Forbearance has been falling every month since that period of time. We just had another waterfall collapse after the program ended. Housing looks perfectly normal if you believe in demographics. If you don't believe in demographics, then all this has to go away, right? There was no way more Americans would be buying homes in 2020 and 2021 than any single year from 2008 to 2019. And I've always separated my work from 2008 to 2019 to 2020 to 2024, because this is different. And you all can see what's happening currently. So housing looks normal. In regards to mortgage rates, I'm a bond market guy, so every forecast has kind of been the same in the previous expansion. The 10-year yield would be to range between 1.6 to 3%. But when COVID came, I thought negative 21 basis points on the 10-year yield, 62 on the upper end. If we're above 62 basis points, the expansion is on. The America's Back recovery model, which was written on April 7th, 2020, that was it. Game's on. We blew the American bears out. So what's happening currently this year looks perfectly normal, because back on April 7th, I said, when things look fine, right, the 10-year yield should be in a range between 1.33 to 1.60. So you have the hottest economic growth in a very long time. You have the hottest inflation data. The labor market's on fire. The 10-year yield today is at 1.47. It looks perfectly normal if you respect the long-term downtrend in the 10-year yield and mortgage rates. So a lot of people have been talking about, well, mortgage rates have to rise because of growth and everything. I capped my 10-year yield forecast at 1.94%. The bottom is 62 basis points. It looks perfectly fine if you respect a long-term downtrend in rates and then 10-year yield. Outside of that, the economy is on fire. There's nothing, nowhere else to say it, right? Retail sales have deviated from historical norms that I'm more than I've ever seen. Home sales are at pre-cycleized. Car sales would be at pre-cycleized if we had inventory out there. The labor market looks actually right to me because well before job openings took off, I did these tweets on Twitter. Jolt's 10 million, right? Job openings over 10 million. Consistently talked about how the labor markets are different because the demographic backdrops are different, right? The baby boomers are leaving every month, they retire. We had 7 million job openings before COVID hit us. So naturally that's going to continue. So everything looks right on the economy side, but housing, again, the housing bears never talked about demographics coherently. I know a lot of people are talking about population growth. Population growth has been falling for 8 years now, right? But why pre-cycle highs demand? Because millennials are the biggest housing demographic patch ever recorded history. You put move up, move down, cash buyers, investors, millennials all together, total home sales, right? And this is the big forecast during years 2020 to 2024. Total home sales should be above 6.2 million. So 2020 is a beat, 2021 is a beat. I'm not a housing boom credit person, but I use the term replacement buyer. So you could see what's happening in 2021, right? A lot of people say, oh, housing's crashing because sales were never falling. The front-loaded purchase application data was always stable. And now we're ending the year on a very strong note. So to all my housing crash trolling friends, much love for you, man. You blew it again.
Slow down, man. You're dropping dimes really, really quick, and people are gonna have to slow this down. Usually, when I listen to content, I put it on 1.5 speed. They're gonna have to put you on half speed to consume it all. So let's slow down, dig in a little bit more. Let's start with a big headline. It's safe to say, from what I'm listening and hearing from you, you disagree with the 1% decline.
Well, here's the one thing. I would think that would be the most bullish thing in housing because years 2020 to 2024, I had a price model. As long as home prices only grew at 23%, we're fine. We have so much headway. So that 5-year period, guess what happened? We had 10% home price growth right now. We have over 15% home price growth right now. So my model needs an adjustment, right? The only problem is inventories are near all-time lows. And the velocity of inventory, that discussion has never been fully discussed in the terms of, in 2014, inventories have been slowly falling every year as purchase application data has been rising. Even 5% mortgage rates in 2018 didn't really budge the existing home sales total inventory. That's why I stress to people, look at that data line and tell me if demand is stable, can inventory really have a high velocity up? So it would be the most bullish thing for me because I could get my model back in line if home prices fell at 1%. But again, the inventory is cracking down again, right?
So when does that stabilize then? You said inventory has been declining since 2014. When does that stabilize? Because as long as demand outweighs supply, housing's fine.
Now you can see why all my interviews I've always talked about, this is the most unhealthiest housing market because demand is stable and inventory is finally cracked to a level, which is under 1.52 million, where you create bidding wars. So one way to get higher inventory is for mortgage rates to get above 3.75%. Right. And that means the 10-year yield has to get above 1.94%, which isn't part of my forecast. So you see the dilemma I have. I've already lost my 5-year price growth model. I need home prices to come back down to realign that. It's hard to get over 2% on that 10-year yield. So rates are stable. Homeowners look better than ever, right? Remember the whole forbearance crash, all that stuff. Forbearance is falling off. So you need higher rates to really create the velocity of inventory to increase. But even 5% mortgage rates back in 2018 didn't do it. The new home sales sector, that's a whole different subject altogether. You can see the spike in monthly supply and new home sales, new home sale market. But the existing market is the big market that everyone cares about. And it's just difficult when rates are this low. And that's the problem, is that demand is stable and inventory is already broken.
Let's stay there with the rates, though, and unpack this a little further. So again, Logan, you're really smart and you go fast. So you got to speak to us at a third grade level. So you talked about why you felt that the 10-year, I think you said, needed to hit 1.9 for mortgage rates to then hit 3.75. I think that was your quote. How does the Fed tapering impact that at all? And that seems like the smartest move if you want to slow down some of this is to raise the cost of money. So how does Fed tapering impact that?
So this has never actually created rates to rise. So let's go back to the previous expansion. When QE1 was ending, people said mortgage rates have to rise and go higher. Bond yields fell, mortgage rates fell. When QE2 ended, people said mortgage rates and bond yields have to go higher. bond yields fell, mortgage rates fell. When QE3, when the taper was happening, and this is part of the work that I've done for Housing Wire, if you look at 2014, when the taper was accelerating toward the end, and then QE3 ended, what happened? Bond markets fell and mortgage rates fell. There has been no evidence recorded in history that when the taper actually occurs, there's any kind of real big movement.
Has there ever been, like, there's a QE infinity is a buzzword, right? Like, has there ever been a real taper, though? A real removal of the Fed's pressure on rates?
The bond market has been going down for 4 decades, well before the word QE has ever been created, right? It is just, this is the anti-central bank people have always done this. They always say the bond market has to go down, but QE, no. There's so much appetite for our debt that you have to make a case that our debt, for some reason, China, Japan, Europe, their debt is going to be more valuable. Our yields are so much juicier than other countries as well. So the notion that the taper was going to create bond yields, look at, we've had all this discussion about the first Fed rate hike, the taper happening. Where's the 10-year yield? It's basically at the same levels I've talked about all the way back on April 7th of 2020. Why? Because the downtrend in yields respect it. And if you just look at the technical basis, the bond market is doing exactly what it's done. The people that have called for higher rates for many years, even going into 2022, a lot of everyone's forecasts have been talked about. They said mortgage rates and bond yields have to rise because of inflation and growth. This is the year of inflation and growth. Rates, we had that big move from the lows in August of 2020, hasn't done much. So, but if you look at the technicals of the 10-year yield, it looks perfectly fine. But you have to respect that. And I think there's the difference between the higher mortgage rate crowd that has not been correct for 4 decades to the technical, the bond markets. There's just too much demand for our bonds. The technicals are winning for 4 decades. It's a hard concept to grasp. I get it, but if this is not the year that the 10-year yield, like if inflation was a real problem or our nobody wanted our bonds, the 10-year yield would be above 3.5%. It's not. It's at 1.475. So respect the technicals. And I'm one of these guys. I'm keeping my same forecast. Mortgage rates could go down next year, right? If you stay within the channel, which I've always done every year, I respect the bond market channel. Until it actually breaks, I'm not going to be one of the mortgage rates have to go higher things. So the Fed tapering is actually historically, especially in the previous cycle, has always had a positive effect for mortgage rates and the bond market. And this is a great example of what we're dealing with today. All this talk about inflation and growth and tapering and Fed rate hikes, and the long end of the bond market is like, eh. The short end of the bond market is, oh yeah, we're on. The 2-year yield is on. That makes sense. But the long end just simply doesn't care because there's too much demand for our debt right now.
So if I distill that down for a consumer that's watching that doesn't understand why the 10 or the 2-year matter to them, in a 3rd grade level, you're saying, and you correct me if I'm wrong, supply is still down, demand is insane. Based off your technicals, you don't see rates maybe going above 3.75. You mentioned why they could drop even. So that means the bull run continues. Here's the distill down to the bull run continues. Is that correct? And for how long?
Well, think about this. We had 5% mortgage rates in 2018. We had 6 million total home sales. So even if we're talking about 4.25, that might create more days on the market, which I would actually love. I'm at the point where I would want more days on the market. I write about it a lot. We want a boring and balanced market. This is not a healthy market, but it's hard for me to go above 1.94% on the 10-year, which is something I've talked about in 2019, in 2020, and in 2021. And we could see what's happened. The technical people won this battle. They've been winning this battle for 4 decades. Get on board this train because the other ways are not working. You could just see the forecast has been wrong for many decades. We're winning this battle because the technicals matter on this, and the demand for our bonds is insatiable out there because a lot of countries' yields are much lower than ours.
You've been very positive, and again, facts don't have feelings. You've written about it. You were even positive. I think you mentioned that the America's Back model was written in April of 2020. Is that right? We talked about it in one of our first interviews. Yeah. Guys, that was like the dark days of COVID, and here's Logan writing about how positive he is about the U.S. economy. So you've been real positive. You've been right. If you follow Logan, he'll actually share some of his returns on some of his homework, which is interesting to see. But for you being so positive, man, when do we finally, or do we ever hit headwinds in the U.S. economy and housing?
So I have recession models too. I'm a big believer that if people don't have recession and expansionary models, you really shouldn't listen to them. So I need 6 kind of red flags to come up before I use the R word. And in the previous expansion, longest economic and job expansion ever reported in history, there was no recessionary data. Here, it's a little bit different. Right now, we're no longer in the early stages of this economic expansion. The recovery is so fast that I raised my first recession red flag on Friday on the jobs report because the unemployment rate got to 4.25%, and that 2-year yield, right? The 2-year yield will tell you when the Fed is going to raise rates, right? So 0.56% is what I've talked about for a long time. Once it's above that, game's on. Game's on. I think it's 68 basis points right now. So what happens is what I've tried to explain is on inflation. Typically, the US dollar makes its biggest percentage run higher before the first Fed rate hike. What that does is crash commodity prices. They did it in 2015 and 16, created a manufacturing recession. World growth tends to get hit. So we're in the early stages of that. Keep an eye on that. I know oil prices had a bear market. Keep an eye on seeing how strong the dollar can do, because that can really impact global growth. But once the Fed raises rates, that's recession flag number 2. There are other things that has to happen before we could get really bearish on the economy. For housing, I'm not a sales boom person, but I just think that with all the Americans needing shelter, 6.2 million total home sales, new and existing together, should be hit. If it goes below that, something that was very common in the previous expansion from 2008 to 2019, I would consider that a miss. It's just we're not even close to that level. So it's the variance of taking live data each week and moving along with that, but knowing that the demographics, the solid demographic patch right there, kept demand stable. So that's why I use the term replacement buyer. I don't use the word credit boom or sales boom. We just have a lot of people in a very unique 5-year period of time in US history that need shelter. And everyone can see what's happening with rent, right? Rent inflation is taking off. Why? People have money. Wages are up. Employment is up. Financial net worth is up. Everything is up right now. So the balance sheets of America, and this is the key, I think, for a lot of people. If you look at homeowners on paper, they've never looked this good. We're talking about household debt payments as a percentage of disposable income, all-time lows. Mortgage debt payments as a percentage of disposable income, all-time lows. FICO scores are all above over 760. Cash flow is excellent. Nested equity is excellent. It's never going to look this good. This is one of the reasons why forbearance has collapsed. My whole theme about forbearance crash bros, it all fell because these are homeowners. They were all legit. And none of them would have lost their jobs because of COVID. Most of them got their jobs back. Those who make over $60,000 income, average homeowner is about $100,000. That income, most of the jobs are back already. So forbearance was naturally going to fall off. So housing has the demographic demand to stay stable. The new home sale market is the different marketplace. That's where rates really impact the sector. If you want to make a bearish housing theme, you have to look at that sector when rates rise. But again, right now we're still 3%. Right. So somebody has to convince me that next year, if the rate of growth of the economy slows because it's too fast right now, it can't be sustained. If the rate of growth of inflation falls down, if the Fed is raising rates to slow the economy, is that the backdrop for higher mortgage rates? The bond market doesn't think so. The bond market has been right for 4 decades. So convince other people to tell you why that kind of environment will require much higher mortgage rates than it is. I can make a best case scenario for higher rates, but that would need the world economies to kind of work together. No more COVID, no more variants, no more anything. Supply chains are fine, and all bond yields move together, right? Japan, Germany, and everything. But we're not at that stage yet. So let's hold up on the higher mortgage rate story for sure thing, because it hasn't panned out for decades. Rates can move up and down within a new economic expansion. But again, the 10-year yield is screaming to everybody right now. Nope, it's not happening.
Guys, this is good stuff. And I know if you're a consumer, you maybe didn't grasp all of that. I know you didn't, because I didn't. I'll have to go back and listen to my own interview to make sure that I understand everything Logan just talked about. So let's do this. If a realtor or a lender shared this on social with you and you don't understand some of the stuff that we talked about today, just ask them. I promise you somebody else is wondering that has the same question. Just go in the chat log and ask them the same, a question of, hey, he talked about the 10-year, why does it matter? He talked about inflation. I mean, you went everywhere today. And I promise you guys, not everybody understands what we're talking about, which is why we need to ask questions. The other thing, guys, Logan is in high demand. Like, you used to be able to get him on Clubhouse for free. He would drop bombs. I'd be at 11 o'clock at night, just sitting on my couch. My wife's asleep and I'm listening to Logan just drop bombs for an hour. But Housing Wire is smart. Like, he's in high demand, so it's difficult to get Logan anymore, which is why I appreciate he carved out time for us. Most of his stuff is on Housing Wire Plus, so I'll give him a plug. That's, for Clayton and Housing Wire, you need to get Housing Wire Plus, because a lot of this good information is on the Housing Wire Plus. He's also got a podcast. Isn't that right, Logan, on Mondays now?
Yeah, Housing Wire, we call it the Rundown. Sarah Wheeler and myself do a podcast now. Every Monday, we go over everything. And the recent podcast right now went over mortgage rates and stuff that we've talked about. So listen, economics is not for everyone. I try.
Yes, it is. I'll stop you. Yes, it is. They may not know it's for everyone, but it is for everyone. Well, you said it's not sexy in your article, which I agree, but it's still for everyone.
Yeah. So we try to create a way for people to understand how it really works. Because in this day and age, it's easier to doom, crash, sell, buy gold, Fed, all that stuff. Hasn't worked out right. So my job is to basically show the progression of each economic expansion to the recession, to the recovery, to the expansion over and over again by showing economic models. Because I've two things I always say: economics done right shouldn't be terribly boring, but you always want to be the detective, not the troll. Right?
And guys, you know this better than I do. Even your clients are asking you every day all the questions I just asked Logan. So the better we understand this, the more value we can provide to our clients and our referral partners. So again, thank you so much. Another reason why you need to get Housing Wire Plus and follow Logan. He's not on Facebook anymore. I think he's just on Instagram and Twitter. You got to follow his podcast. I'll throw one last bonus question in there just for fun. I asked you, I think about a year ago. Now I'm curious, has your mind and stance changed at all on crypto? You got any NFTs in the portfolio?
No crypto. Like I said, on the economic side of crypto, there's not enough people that own crypto to really matter. So whatever the price goes, I mean, you can make lots of money trading crypto, but even if crypto falls 20 or 30%, there's not enough consumption based on it. So I think for like 4,000 people own most of the crypto in the world. So it's a great trading vehicle, but it really doesn't have any economic value in terms of retail sales. I mean, some people might buy stuff where there might be a home purchase here or there, but the velocity of that of any kind of crypto coin, it only bears to the people that have a lot of it, and so few have so much of it. Their life is great, but in terms of like how it would impact the economy, it's just not big enough out there. When we saw what happened when the government actually gave checks to people, you saw the savings rate skyrocket, you saw disposable incomes go up, and then when it winds itself down, because remember, people spend, right? That's our economy. The savings rate falls down, the disposable income comes down. Very historically, that happens off of one-time events. That is more important than crypto. So crypto, even if crypto fell another 30%, it doesn't really matter much to the economy.
Yeah, you have to wonder that. I'm not in crypto at all. I don't have any Shibu or Shiba or Bitcoin or Dogecoin. I'm studying it just because I'm curious. I'm a learner. I'm learning about NFTs and the metaverse and buying virtual worlds and stuff because it's interesting, but I still don't understand it well enough to push a significant amount of money.
Yeah, I am way too boring for that kind of stuff. I just buy like normal companies. So.
But you have to, like you said, there's such a gluttony of cash. I can understand why there's money funneling into it, but you got to wonder if that changes.
The shortage of financial products to buy has been here for a very long time. Why? I mean, there's a global liquidity. There's so much money out there, and a lot of people put the money into the bonds. So that's one of the things. So, a lot of people have cash, and I think honestly, there's a lot of rich people that are bored, and this stuff is fun for them.
100% accurate, right there.
So I mean, I'm just.
And they're in our industry, by the way. There's a lot of them in our industry. Yeah. We've had some good years.
It's just like I could see the appeal because the action is very fast going. So in terms of the general economy, it's just not a lot of people own enough of it to matter. But it's exciting, as everyone can see, the thought of buying something at 0.01 cent or whatever and having it go up. And, if you've had enough of that shares of that, you can make yourself money. So there are a lot of people who made money in that. I just don't think there's enough of them to matter. Like some people say, well, people are all making money off crypto and they're not working. No, not really.
Yeah. Yeah. Well, man, I appreciate it. We went long today, but I know the viewers, I'll just say this. I know the viewers appreciate all your homework, and we will post all the articles that we mentioned down below, and also a link to Housing Wire Plus and Logan's podcast.
And also questions. I love questions. So if you do have questions, Instagram is the place. Literally, I get questions every day. I give video responses. I try to answer everything and try to explain as much as I can, because as a technical data person, my job is to explain to you what's going on. And if I can't do that, that's a failure on my part.
I will support that. I mean, Logan, I've texted him real quick, even about this interview yesterday, and he's always really fast to respond, which is amazing because he provides so much value for the whole industry that he's that accessible. So take advantage of that, because until he gets
I'm retired. I have nothing else to do.
Yeah,
this is all I do now.
Just talked to a bunch of mortgage people and realtors and anybody else that wants to talk about the market. So man, I really do appreciate it. I know you're in high demand and very, very busy. Honestly, thank you so much for spending time with us.
Pleasure is all mine. It was a great time.